The following program is a special presentation of the Big Ten Network, produced in association with the University of Wisconsin.
Buying a home has always been the foundation of the American dream. But when the real estate bubble burst, some started to question that fundamental notion. What was once a safe bet has, for some, turned into a risky investment. We'll examine the reality of real estate next, during office hours. Hi, I'm Ken Goldstein, Professor of Political Science at the University of Wisconsin-Madison. On this segment of Office Hours, we are looking at the uneven terrain of real estate and what it means to be an American homeowner today. Joining us to discuss the U.S. housing market is Morris Davis, Professor of Real Estate and Urban Land Economics in the Wisconsin School of Business. Davis worked at the Federal Reserve Board for 6 years before joining the UW-Madison faculty. He is currently a fellow at the Lincoln Institute of Land Policy. Morris, welcome. I should also say in the introduction, you are the lead guitarist in the band Hot Money, made up of local economists here. I think we need to put that out there in your introduction. We're going to have a wide-ranging discussion of the factors that influence real estate in the United States today. But I think it's worthwhile for you to sort of summarize the situation that we're in now in terms of housing prices and their direction and the trends we're seeing now, fall 2010.
Right, so where are we right now? My view on this is that housing prices and activity have hit bottom and might have hit bottom a few quarters ago. I track a few different metrics. One metric that I track is called the rent-to-price ratio. That has an equivalent statistic to something in finance called the dividend yield. The rent-to-price ratio is an indicator of future returns to housing. That rent-to-price ratio right now in the U.S. is about at its average value.
Let me interrupt for a second, have you explain that a little more. So that means if I'm thinking about buying or renting, what the cost to me is of renting or buying, whether it makes more sense for me to rent or buy? Is that what it is?
It's very similar to that.
Okay.
The question is, what's the ratio of the rental price, the yearly rent of a unit, relative to how much it would cost to buy that unit? It's like so if you think of a house as spinning off a dividend, that dividend would be the rent. So it's like the dividend yield in finance. And it's very similar to what you said. If I were to rent a house rather than buy it, how much would I pay to rent? So that ratio, the rent-to-price ratio, tells you something about the future expected return to housing. The ratio right now is at about its historic average, meaning that housing returns going forward should be, say, roughly equal to their pre-boom level. You should expect something like, on average, a 1% per year appreciation to the value of your house.
So all these people paying attention to, and the big metric we hear is housing starts or the value of housing going up or down. That's the scorecard we tend to get on a monthly basis. Should we be paying attention to that? Is that something that you pay attention to?
A bit. I pay attention to two things. One is the rent-to-price ratio, and the other one is the value of land. But speaking to starts and affordability, those metrics are correlated. So starts is about quantity of housing, but the quantity of housing and its price are highly correlated. So if you see a good starts number, that's indicative, correlated with the fact that maybe house prices should be turning up. But as I say, I track the rent-to-price ratio because that does have a definitive analog in finance. And I also track the value of land.
So a lot of the coverage we're seeing is how there was a bubble, it burst, decline in housing prices, then stabilized, started to come up again. But now a lot of the coverage in the media is it's going down. You're less pessimistic.
I think now could be a historic time to buy real estate. And Ken, you've known me long enough to say that wasn't always my point of view. Every quarter I don't say now's the best time to buy. I think for many reasons now might be a once-in-a-generation time to buy real estate, residential real estate specifically. Partly because the downside risk to me appears low. House prices have already fallen 40% in real terms. They shouldn't, if they're going to fall, they shouldn't fall much further. Second, there appears to me to be the rent-to-price ratio suggests that housing's poised to earn its historic rate of return. And third, the other metric that I track is the value of land. And land appears significantly undervalued at the residential level. And to give you an idea, I think the value of land is undervalued in the aggregate residential side by about $1.5 trillion. So just returning to normal sorts of metrics would give the next set of home buyers healthy returns to housing. Plus, there's significant upside potential. If we have any kind of inflation, which some might expect over a 5 or 10-year period, then housing is going to pay a great return.
We're going to get back to this discussion, this distinction between land and the structure that's on the land in terms of valuing real estate. But in politics, we say, especially in this congressional election season, all politics is local. All real estate is also, to a certain extent, local. There is some variance across the country, and certainly certain areas of the country, inland California, inland Florida, Nevada, Arizona, had much more significant downfalls than other parts of the country. Is what you're saying generalizable, or does it really matter where we're looking?
So the fact, land being a great hedge against inflation, that's generalizable. Because land is in scarce supply and it pays a real dividend, which is the value of a given location. The recovery in the absence of an inflation, just a normal recovery to healthy periods, that will vary across locations. I don't expect Michigan necessarily to recover as fast as, say, New York. Partly that's the economic situation, and that's the sense in which you're absolutely correct. All real estate is local, but just to give people some idea, this last boom and bust, all real estate was not local. Almost every area of the country had a boom from '96 to 2006. The boom varied in magnitude, but almost everywhere had a boom, and almost everywhere had a bust between 2006 and 2010. And again, the bust varied in magnitude. So there are some general trends that are nationwide. It's just these magnitudes. The specific magnitude can vary with location.
Great. Thank you, Morris. Please stay with us on Office Hours as we continue our discussion of real estate trends in the United States with Professor Morris Davis.
This program is a production of the University of Wisconsin-Madison. If you have comments about this broadcast, please email them to programming@uc.wisc.edu.
Where others saw lumber, we recognized a treasure. Where others saw the night, we chose the stars. Where others saw pieces, we unlocked the puzzle that could mean the end of paralysis and cancer. Since 1848, thinkers and achievers at Wisconsin have fearlessly sought ideas that transform the world. Keep on, Wisconsin. Keep on.
Welcome back to Office Hours. We're with Morris Davis from the Wisconsin School of Business discussing real estate, trends in real estate, and the American dream. Morris, in our conversation in the first segment, you made a fairly strong argument that you think real estate is going to be on the upswing in the coming years, and you gave us some reasons why. It's also the case that our population is growing. At some point, we hope to come out of the economic doldrums that we're in, and there's going to be a lot more people working. That's also going to have an influence on real estate and real estate prices, right?
Yes, very much so. So there are people that say that maybe housing is going to bottom out some more, and the reason they say that is they think the recession will get worse, and in a recession, the number of households tends to shrink because teenagers move back with their parents and people join up households. So suppose we start having a normal-looking expansion, and we have population growth. Under those two scenarios, over the next 3 years, we're going to create something like 12 million jobs. And with all these new jobs, people will start moving out of their parents' households, so there'll be a demand for housing. We have a steady population growth, so normal recovery will just imply that house prices go up. If you add to that the fact that land is currently undervalued by some metrics, and you add to that the risk of a significant inflation, there might never be a better time to buy a house than right now.
So talk to me, though, about that risk of a significant inflation, because I'm also reading that people are fearful of it. One, a double-dip recession, and two, that we could have deflation or not a big enough inflation. Why is inflation important for home owning?
So first, the people that talk about deflation, they could be correct. Overall consumer price levels could fall over the next year or two. But I believe we have a Federal Reserve that's committed to fighting deflation, potentially at the expense of inflation. So
and that's one of those things where people say, well, Why is inflation a good thing? Take us through that, because it's especially the case with the real estate prices. I mean, obviously, hyperinflation is not a good thing, but moderate inflation is important for an economy.
Well, let's talk about the decade of the 70s. In 1970, the average price of an owner-occupied house was a number like $20,000. In 1980, the average price of an owner-occupied house was something like $60,000. So prices increased by a factor of 3. House prices increased by a factor of 3. Consumer prices, we had a big inflation, so consumer prices they increased, but only by a factor of 2. So housing was a good hedge against inflation because house prices increased faster than inflation. So that's the first thing. And then the second reason is that when you purchase a house, it's a levered investment. You can buy a $20,000 house with 20% down. That means you put $4,000 equity in, and you do that with a $16,000 mortgage. So let's think about that. The $4,000 equity that you put down in 1970, if you were our parents, say, that was $8,000 in 1980 dollars because of the inflation. Remember, prices increased by a factor of 2. So 4,000 1970, that's 8,000 1980. So what does that mean? In 1970, you had $4,000 of equity and $16,000 of debt. In 1980, you still only had $16,000 of debt. Yet you had a house worth $60,000.
And I'm paying the same monthly payment
And
on
you're
my
making
mortgage.
the same monthly payment.
But that money is worth less.
It's a bit like saying $8,000 returned to you $40,000 when you do the math. So how is it the house purchase itself delivered to people that purchased in 1970 a 5 times real return on equity? That's what inflation does. It makes levered investments a great deal.
Now, another thing that you hear is that whether you think housing prices are going to increase depends on whether you think housing is a luxury or a staple. Take me through that.
There's a question about should prices be falling over time or rising over time, so if housing were purely a manufactured good, then you'd expect its price to be falling over time, the same way that prices of DVD players falls over time. We don't see house prices falling over time. We see them rising over time, which means that something about housing is not manufacturable. So this is why I focus on the land. The reason that house prices have been rising over time is there's something about it that's not manufacturable, and that's the location component. So then the question is, should the price of land be rising over time? And this gets back to your question, is it land a luxury good or is it a staple? And if it's a staple, say, and it's in fixed supply, then you'd expect its price to be rising with income, the price of land to be rising with income, which we notice. So this discussion about whether or not house prices should be falling or should be rising, roughly the same discussion can be had where we could ask, what's the long-term trend of the price of land? What should it be? What is it?
Let's come back in this next segment to that discussion of luxury versus staple. Please stay with us on Office Hours as we continue our discussion of real estate in the United States. Welcome back to Office Hours. Joining us today is Professor Morris Davis from the Wisconsin School of Business, and we're discussing real estate trends. Morris, let's go back to this discussion of luxury versus staple, and tell me if I'm getting it right here. If incomes are rising, and I still spend the exact same amount of money on my housing, then we could say housing is a staple. So the same way that food's a staple. If I make $50,000 and I spend $5,000 on food, even if I'm making $100,000, I'm still spending $5,000 on food. Yep. If it's a luxury, the more money I have, the more money I'm willing to spend on this other special thing, my new snazzy house. Is that getting it right in terms of the debate, and does that have implications for whether you think real estate's going to go up or down?
Yes. So I think I confused luxury versus staple. Sorry about that. So let's talk about expenditure shares. The question is, as incomes rise, do people spend more or less on housing? And I think as a percent, that's extremely hard to measure when you're talking about purchasing a house, because a house has in it current rents and future expected growth of rents. You can look at what renters do. And it appears that over time and across places, renters at the median spend about 24% of their income on rental expenditures. So I don't know if you call that a staple or a necessity, but it does appear that rental incomes increase dollar for at least 24 cents per the dollar with
And that's
income.
consistent as income goes up?
Yeah, that's, you can look at data from the 1980, 1990, and 2000 census across 300 MSAs or so, and then just look at what does the typical renter spend as a fraction of his or her income. And that number is about 24%, independent of time or place. So I guess that gets at your, and that's why, so if you know that.
And independent of income, if I'm making
Yes.
20,000, if I'm making 50,000, making 100,000, making 200,000?
Independent of the average income of that MSA,
Okay.
of that statistical area. And this gets at why does land value rise? If people have a rule that they're going to spend 24% of their income on housing rents, and land is in fixed supply, then the price of land is going to reflect that, that increase in expenditure.
Government is obviously involved in lots of areas of the economy, but in real estate, both through tax policy and through having a huge influence on what interest rates are, government also has a very large influence, perhaps the most significant influence on real estate prices. Talk to me a little bit more and hash out some of what the role of government is in influencing real estate prices, housing prices in this country.
Well, we just saw what the home buyer tax credit did. It pulled a lot of potential future sales forward. So there was a huge sales and huge surge in sales prior to the expiry of the tax credit, and then a decline in sales afterwards. So we know the government can influence prices and quantities. There's this old saw out there that the government subsidizes owner-occupied housing. And the reason is that if you're a landlord, you have to pay rents, you have to pay taxes on your rental income. If you're a homeowner, you pay no taxes on your rental income because your rental income is undeclared. You don't really spend any rental income, but it's there. So there is some subsidy to owner occupancy through the tax code. I just want to point
And also through the mortgage interest deduction as well, correct?
Yeah, well, so that's trickier. All mortgages have interest deductible from taxes. So that's not a subsidy of owner occupancy. That's a subsidy of real estate. Because if you're a landlord and you have a mortgage, that mortgage interest is tax deductible. I just want to point out that the subsidy of owner occupancy is not as big as some people think, because landlords can deduct maintenance from their taxes, whereas homeowners cannot. But there is a subsidy, and the government does play a big role in this industry.
But in general, overall, can we quantify how much more expensive or how much more higher the value of real estate is because of the mortgage interest deduction?
So we know that the government subsidizes Fannie Mae and Freddie Mac. And so you could argue, even if there's no explicit subsidy through the tax code to owner occupancy, there is an explicit subsidy of the mortgage interest through the entities Fannie Mae and Freddie Mac, which help securitize, or that is bundle, home mortgages and sell them into a secondary market. The big debate was about how much cheaper Fannie Mae and Freddie Mac make mortgages.
Let me have you hold that thought in the last segment. We'll get back to what they should do, and also get
40 basis points.
40 basis points, and we'll
Yes.
get back to Morris and have Morris Davis policy prescriptions about what we should do in terms of housing and real estate policy. Please stay with us.
This program is a production of the University of Wisconsin-Madison. If you have comments about this broadcast, please email them to programming@uc.wisc.edu.
Welcome back to Office Hours with Professor Morris Davis from the Wisconsin School of Business. Morris, you mentioned Fannie Mae and Freddie Mac. We hear those terms, we hear those companies all the time. What exactly do they do?
Fannie Mae and Freddie Mac, they buy mortgages from banks. So you walk into a bank and you want a mortgage. Bank gives you a mortgage. Then what does the bank do with that mortgage? It turns around and sells it.
So we sign that form saying you're allowed to sell our mortgage.
Yep, and then off it goes to Fannie Mae or Freddie Mac. Then what Fannie Mae and Freddie Mac do, they bundle these mortgages together to create a bond, which has some cash flow associated with it. And they do one other thing too. They add a security guarantee. So they don't insure. So they make a bond and they sell a bond to some investor. And this is called a mortgage-backed security. That bond has one risk in it, prepayment risk. All the default risk has been insured by Fannie Mae and Freddie Mac. So they charge something called a guarantee fee, and that means that if the underlying mortgagee has defaulted, Fannie Mae and Freddie Mac will make up the principal in whole.
And that was why there was such a problem with Fannie Mae and Freddie Mac, because there was many more foreclosures than they had expected, so they were on the hook for a lot of money, essentially.
Basically, the security guarantee wasn't large enough. And so when nobody was defaulting, they were booking all this great income and they were paying it out as bonuses to their presidentially appointed board, and they were paying it out as dividends to their shareholders. And then when all these foreclosures came, and they also were, unfortunately, they were also allowed to operate as a large hedge fund, and they had some risky additional investments. And when all those investments went bad and when all these foreclosures occurred, at the end of the day, the net loss to taxpayers, the net present value of the losses is about $400 billion.
Let me read you two quick quotes here. One from Bill Gross from PIMCO, very big bond fund in this country. The only way to bring housing back and to create liquid mortgage financing going forward would be to provide a government guarantee. So he's arguing for more activity by Fannie Mae and Freddie Mac. And then Alex Pollock from the American Enterprise Institute, not surprising from the American Enterprise Institute, is suspicious of that, saying you can either be a private company or a government agency, but not both. So Fannie Mae, Freddie Mac put into place so the banks will then have more money and the security to be able to keep providing mortgages, but there's also this risk in this government-private netherworld there. If Morris Davis is sitting in the White House, which side do you come down on in 1 minute?
The 1 minute answer is I would try to shrink Fannie Mae and Freddie Mac. There's a lot to talk about with Bill Gross's comment. There are some people that are skeptical of his motives. I don't want to say too much other than it's widely believed that Bill Gross is underweight mortgages in his portfolio. I don't know if that's true. I don't want to say any more of that, but I will say that I'm hesitant to see more government involvement in this marketplace, given that we just lost $400 billion of taxpayer money. The one thing I will say that Fannie and Freddie do is they provide liquidity. So in the time of a crisis, at the time of the financial crisis, jumbo mortgages were almost impossible to get. If you could get them, they were expensive. Fannie and Freddie were there still issuing mortgages. So at the one time in American history where it appeared that the financial system was falling apart, there was still at least Fannie Mae and Freddie Mac. So if we dissolve Fannie Mae and Freddie Mac, we're going to lose that bit of insurance. But that's the only cost as far as I can see it.
Okay, Morris, thanks so much. Lots to talk about with real estate, and you're a familiar face here on Office Hours, and we hope to have you back again soon. So, thanks to all of you for joining us today. Don't forget, Office Hours on the web via our university website, Facebook, or Twitter. Take a look and let us know your thoughts. From the University of Wisconsin-Madison, this has been Office Hours. Thanks for stopping by.
The preceding program was produced by the University of Wisconsin in association with the Big Ten Network.